Well, Samiran, what's your sense? What is your reading of inflation in on Wednesday itself? I mean, on Thursday, and in the coming months. Do you think that enough has been done to take the toll, to take the pressure of aggregate demand off, or would you agree with what Dr. Sen is saying, that perhaps we have to wait for inflation to fall before the RBI takes any action?
Yes, as in if you look at the headline inflation, that has been quite sticky, but if you go component by component and look at what are the structural components of inflation where RBI probably has less room to have an impact, what comes out is that the core inflation number, where traditionally RBI should have more impact, is coming down, and that's not surprising given that 5.3% growth is much lower than what we think of potential growth to be about 7.5%. So it's probably with a lag that inflation is coming down, but I'm pretty sure that the core inflation number at least will come down. The food and fuel inflation is much harder to predict, and they are more either imported in nature or structural in nature, and their RBI policy might not have too much of an effect. So on the basis of potential growth being much higher than the current growth and core inflation falling, I would like to argue for some scope for monetary easing.
What is some?
Definitely at this point of time 25 basis point, but the bigger question, as Vivek was mentioning, is the forward guidance. The forward guidance should become more balanced now, with some comfort that if growth slows down further, then RBI is there to take care of some kind of monetary stimulus. I think that message needs to come. Otherwise, just a 25 basis point cut with a hawkish statement will have absolutely no impact on markets.
Let's get Venugopal Dhoot, the CMD of Videocon, to join in on this conversation as well. Hi, Mr. Dhoot. Thanks very much for joining in. What have you made of the IIP data this month, and what do you think investment and consumption patterns look like?
You see, this time it doesn't look that bad as we have seen last month, because it seems that something is improving and government is taking the step. Inflation is also coming down, and one more on the 18th of RBI will be giving this, I think interest rate will be reduced drastically, and corporate world will be happy with that. And that's why this month also the mood is good. And last month it was not bad. Look at the consumer durable, 5% growth is there. But we see the growth of 15%. So one wonderful question, I always feel how this happens. This time I could make the solution. For example, Sony, give an example only. Sony, they import everything from Thailand at zero duty, because from Thailand it is a zero duty. So imported goods are coming, and Indian goods are not getting manufactured. And that's why IIP number you see it less, but market-wise it is 15-20% growth is here. When we are interested in market, whether it is produced in India or whether it is produced in Thailand, because we also have plant in Thailand and all over the world. So far as Indian manufacturers are concerned, they are not worried whether the IIP number is high or not. I am speaking about consumer durable, whether IIP number is high or not.
Yeah.
What we look is the marketing. And marketing side, it is we are getting the growth of 15%.
Are you getting a sense, Mr. Dhoot, that consumer, at least consumption of consumer goods, has stabilized or improved? Because the April number is much better than the March number, and in fact even better than the full fourth quarter numbers. Is that the experience on the ground, that consumption has slightly improved at all?
Yeah, consumption has been going up. You see, in this budget also, in the name of inclusive growth, the finance minister has given a lot of subsidies to the people who are living at the bottom of the pyramid, and they have got money and they are spending. And that's why consumer durable growth is going up and up. And as I mentioned, that imported goods are more, so your IIP numbers are less. But the growth is there in consumer durable, and people are looking at the interest rate cut, etc. After that, I think from August onward, because of the season and interest rate cut, and people are having money, all these factors, the consumer durable growth will go. And talking about the country's growth also, you can see the country, our GDP growth is around 6%, and this is enviable to all European countries. So if we keep
Yep.
this standard and go on future further growth, I think this is a very good time for the country.
Okay, I hope so. Mr. Dood, thank you very much for joining us. Sajid, the picture I paint in my mind of the future is more like what Dr. Sen is pointing out. Terrible comparisons reminding you of 1997 or even 1996 with growth at single digits, in fact low single digits, and inflation at double digits or almost double digits. And we had that Rangarajan phase where we had punishingly high interest rates. Remember, PLRs of 17% and 18%. What's your sense? Can we slip into that period? I mean, the rupee is also behaving like it was behaving in 98.
Yeah, but that is a sobering prospect, and the way you square single-digit growth and double-digit inflation is when your potential rate of growth falls. So, so the worry is if potential falls enough, then even if you're not growing very fast, you can stoke inflation. Let's hope we can avoid that. I think the good news is that many of the things we can do to avoid that are in our hands. This is not an exogenous shock. And if policymakers in Delhi were to do some basic things to turn around sentiment, I think we can perhaps get some movement on the investment front. I just want to turn attention a little bit to the currency. Let's not forget the extreme pressure that the currency has come under in the last couple of months. That affects sentiment, yes, but it also has an impact on inflation. We saw in 2011 when the currency plunged in the second half, that had a very significant impact on core inflation in the coming months. So we need to be very wary of undue haste in cutting rates, because the impact of this currency weakness will likely show up in the next few months, because imported input costs across the board have perhaps risen on account of a weakening rupee.
On that issue, Vivek, even if there were a 25 basis point cut, how much do you expect can get passed on? I mean, if inflation, especially consumer inflation, is at 10%, doesn't leave much elbow room for banks to cut deposits, does it? Or do you expect that rates could get passed on?
That's a question to me?
Yes, Vivek.
Yes. As far as the transmission to the banking system is concerned, we expect, as the banks are saying, the liquidity should be improved in the system. And as far as liquidity improvement in the system is concerned, either a CRR cut needs to be there. Just a repo rate cut probably won't lead to transmission of deposit rate cuts as expected by the RBI.
Okay, Samran, just wanted your perspective with regards to the probability of the RBI not moving on June 18th at all, simply because there is a lot of event risk that we're working with, because the FOMC meets at the end of the month, and then if they do announce something in terms of monetary easing or some sort of operation twist extension, then we all again are playing with that crude risk because of a risk on which we could possibly see globally. Do you think that the RBI is possibly going to wait, watch, see what happens in Greece, and then see what happens in the FOMC meet, and then possibly move on in a more ad hoc manner, the way they had with regards to the CRR sometime back?
Definitely, the RBI meeting is sandwiched between the Greece election and the FOMC, so it's not an ideal day to announce decision based on global factors. But as we were discussing, there are several domestic issues that also RBI needs to take into account. So in my view, RBI would be more concerned about the domestic dynamics of growth and inflation in taking a call on 18th rather than looking at the global factors. If global factors play out in an unexpected, disorderly fashion, then there is no harm in being nimble and flexible and coming 10 days later and changing the stance. But on 18th, I think the focus will be more on domestic issues.
Samiran, in the light of what Dr. Sen was saying in terms of inflation still being intractable and growth not showing any signs of pickup, the S&P paper which we got yesterday, written on June 8th, is painting that as a possible worst case scenario, just that things could get there and governments could react, could perhaps retrace some of the liberal steps taken, and populism could take hold of policy making. In any case, the long and the short of it is, how much degree of possibility do you attach to it? Can we slip into that scenario, you think, of the late 90s?
I think these historical comparisons are always tricky because in a dynamic economy like ours, the structure of the economy is changing very rapidly every 5 years. But having said that, I think if you just look at the S&P paper, I think what it does, and it does quite elaborately, is explain why in April they had changed their outlook to negative. So this is kind of an ex post explanation of their action taken 2 months back. I'm not reading anything beyond that in this paper, but as you rightly mentioned, that the paper concentrates on advising the government what not to do in a situation of falling growth and high inflation. That's precisely the message, that don't slip into a kind of a non-market protectionist, populist kind of mold. Continue with the liberal stance. I think that's the message that I am getting from the paper.
Dr. Sen,